Welcome in. Today we're unpacking one of the most misunderstood and underestimated costs facing Manhattan hospitality operators, the New York City Commercial Rent Tax, or CRT. As we move deeper into 2026, you're not just battling razor thin margins and sky high Manhattan rents. You're facing a unique municipal predator that devours profits square foot by square foot. While the rest of the country operates without this burden, every restaurant south of 96th Street must master this tax or risk financial catastrophe. On paper, it can look deceptively simple: a nominal 6% tax, reduced by an automatic 35% deduction, producing an effective rate of 3.9%. But as we'll see, the real story is far more complex. For restaurants in this zone, CRT isn't just a tax form issue. It can shape lease negotiations, accounting systems, audit exposure, and ultimately whether already thin margins hold up at all. So let's pull back the curtain on this formidable challenge and map out the battlefield you're operating on. Here's the brutal question keeping Manhattan restaurateurs awake at night. When does a hospitality operator actually cross into CRT territory, and what payments even count toward that calculation? This matters enormously because most operators focus only on quoted base rent when the city's definition of rent is far broader. The liability threshold is based on annualized gross rent of $250,000 before the 35% reduction is applied. In other words, the tax trigger can arrive earlier and more unexpectedly than operators anticipate. Many operators believe they're safely under the threshold, only to discover that their triple net lease charges have secretly pushed them into taxable territory. And the city's annualization rules mean that even a short-term or mid-year opening can cross the threshold faster than anyone planned. This isn't theoretical. It's a daily reality where misunderstanding a single definition can trigger catastrophic tax liability. But to really understand why operators keep falling into this trap, we need to go deeper into the gap between how leases are written and how the Department of Finance actually reads them. So why do even experienced operators keep falling into this trap? The gap in existing knowledge is staggering, and it comes down to a fundamental mismatch between how operators informally think about occupancy cost and how the Department of Finance legally defines rent. Traditional lease thinking says, if my minimum rent is below $250,000, I'm probably fine. But CRT doesn't work that way. Under NYC Administrative Code Section 11701, the definition of rent doesn't just mean your monthly check to the landlord, it devours every payment you make on their behalf. Real estate taxes they should pay? Added to your rent. Their building insurance? Added to your rent. Water and sewer bills? All added to your rent. This is the triple net trap that's quietly crushing restaurants that believe they're operating safely under the threshold. And here's what almost nobody tells you. The Department of Finance doesn't care about your lease title. They annualize partial year rents, recharacterize commingled charges, and audit with the precision of forensic accountants. Existing approaches fail because they treat the CRT as a simple percentage calculation, rather than a sophisticated system of definitions where every single word in your lease becomes either a weapon or a shield. The knowledge gap isn't just about missing deductions, it's about fundamentally misunderstanding the battlefield itself. Now we arrive at the breakthrough approach, and the central insight is this. Treat CRT as something to be designed around, not merely reported after the fact. The methodology has three interlocking pillars. First, lease architecture. Instead of accepting a landlord's standard lease and hoping for the best, you engineer the agreement from day one. Replace high fixed base rent with lower base plus percentage rent tied to net sales, because percentage rent is excluded from CRT calculations. Demand separately metered utilities for your commercial kitchen's massive energy consumption, because documented separation keeps those costs outside your tax base. Structure tenant improvement allowances as direct rent credits rather than amortized additions to base rent. And consider subleasing excess space to ghost kitchens or pop-ups, because every dollar of subtenant rent is a dollar deducted from your CRT liability. Second, accounting precision. By meticulously documenting every food cost, beverage purchase, and packaging expense as cost of goods sold, you can legally reduce your total income figure and potentially unlock the small business tax credit for businesses with total income under $5 million and base rent under $500,000. Third, compliance defense. Quarterly filings on September 20th, December 20th, and March 20th, and your annual return by June 20th, must be treated as hard deadlines, even when no tax is owed. Miss these, and you face penalties that compound fast. This isn't theoretical. This is financial engineering that transforms your lease from a tax liability generator into a tax minimization instrument. This is where the magic happens, and the findings are genuinely transformative. The most powerful breakthrough is the cost of goods sold strategy. Here's the revelation. Your $8 million grossing restaurant isn't actually an $8 million business for CRT purposes. By meticulously documenting every food cost, beverage purchase, and packaging expense, you can reduce your total income to $4.5 million, clearing the $5 million threshold and unlocking the full small business tax credit. Suddenly, your effective 3.9% tax rate evaporates to zero. That's not a deduction. That's complete elimination of the tax. But the findings go even deeper. The largest savings often come from getting classifications right, not from exotic loopholes. Separately metered utilities stay outside the base rent calculation. Properly documented tenant improvement arrangements avoid being swept into taxable occupancy payments. And sublease income directly reduces the prime tenant's taxable base. Then there's the phantom filing threshold. Even if no tax is owed, any gross rent exceeding $200,000 requires full annual reporting. Miss it, and you face an 11% interest penalty assessed by the Department of Finance that compounds monthly. The data is unambiguous. Operators with tight documentation face audits with confidence, while those without it face average assessments 30 to 50% higher, plus crushing interest penalties. This is the difference between financial survival and catastrophic failure. Now let's talk real-world impact. What this actually means for your bottom line in 2026. Imagine you're running a high-volume Manhattan steakhouse. Your margins are already compressed by the new $17 tipped wage rate and rising food costs. The CRT hits you for $19,500 on your $500,000 base rent, a margin killer that could tip you toward closure. But by implementing these strategies, that liability evaporates. Separately metering your kitchen utilities removes $18,000 from your taxable rent. Documenting your COGS pulls your total income below $5 million, unlocking the full exemption. Subleasing your prep kitchen to a ghost kitchen reduces your taxable base by $48,000. Suddenly, you're not just surviving, you're thriving. But the implications extend well beyond a single tax return. Because federal rent deductions and city CRT calculations don't use identical definitions, weak reconciliation between your federal Form 1120 and your CRA can invite multi-agency audit scrutiny. Shared kitchens, pop-up licenses, and sublease arrangements create unusual cash flows that need airtight documentation. And with the 2026 One Big Beautiful Bill Act locking in the 20% qualified business income deduction, ignoring the interplay between municipal, state, and federal reporting can unravel your entire tax strategy. CRT optimization has become a core pillar of operating strategy, not a niche back-office concern. This brings us to the fundamental paradigm shift that separates thriving operators from failing ones. The old approach treated the CRT as a retroactive nuisance, something to deal with after the lease is signed and the restaurant is already operating. The resolution is clear. You must treat CRT planning as a strategic variable integrated into your pre-opening phase, your lease negotiation, and your corporate structure. This is a complete inversion of traditional hospitality financial planning. Instead of asking, how do we pay this tax? You ask, how do we engineer this tax out of existence? That means modeling annualized rent exposure during site selection and letters of intent before you've committed to anything. It means negotiating leases so taxable base rent stays as lean as possible, with separately metered utilities, clearly segmented TI allowances, and percentage rent wherever possible. It means structuring your S-Corp with surgical precision, balancing W-2 wages against distributions to maintain that critical $5 million income threshold while maximizing your 20% QBI deduction. And it means inserting automatic pass-through clauses so that if CRT is reduced or eliminated legislatively, you, not your landlord, capture 100% of the savings. Stay alert to policy shifts too, including the 2026 debates around INT 0084-2026 and targeted CRT relief. This proactive stance transforms you from a passive tax victim into an active financial architect. The future belongs to operators who blueprint their tax strategy before they blueprint their kitchen. Let's bring this all together with your actionable roadmap. The margins between sustainability and failure in Manhattan's hospitality sector depend directly on mastering the commercial rent tax. And the bottom line is this: CRT hides formidable complexity inside ordinary lease language and familiar operating expenses. But once you understand the definitions, the thresholds, the deductions, the small business tax credit, and the filing rules, it becomes something you can actively manage and, in many cases, eliminate entirely. Your key takeaways. First, engineer your lease from day one. Separate base rent from CAM charges and utilities, structure TI allowances as direct rent credits, and negotiate percentage rent over high fixed rates wherever possible. Second, obsessively document your cost of goods sold. That $3.5 million in food and beverage costs could be the difference between a $19,500 tax bill and zero liability. Third, install separately metered utilities before you open. It's one of your most powerful and most overlooked deductions. Fourth, calendar your compliance religiously. Quarterly filings on September 20th, December 20th, and March 20th, and your annual return by June 20th. Even if you owe nothing once your gross rent clears $200,000. Fifth, build audit armor that lasts. Maintain itemized documentation for 3 years, contractually separate every expense category, and align your federal and local filings with precision. Operators who treat the CRT as a strategic planning tool not only survive, they thrive. The choice is yours. Implement these strategies, join advocacy efforts, and transform this formidable tax from a survival threat into a genuine competitive advantage. Like and subscribe for more helpful videos like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.